investors. For the last 5 years, it was variable to founders. I think investors are taking advantage, they're leveraging the public market as references, they want to get the best deal possible, they're structuring if it's on late stage to protect. But you don't invest for the downside, you invest for the upside. And so the growth and the fundamentals of the business are critical. And then you want to be in the right cap table. I think that's also what matters. And so not FOMO or chasing, but this whole Gen AI, I'm laughing, I'm like, look, Gen AI needs an applied AI use case. Okay? They're still chasing the enterprise use case. Everybody thinks, oh, it's amazing enterprise tech. No, great in certain contexts, but not enterprise ready whatsoever. They're struggling mightily right now to try to make it ready for them.
Oh yeah, and we didn't answer the AI specific question. So a 3 million ARR deal recently got priced at 600 million. So and there were like 4 term sheets on the table.
And then you who's going to buy that evaluation?
Yeah, and another company that had 10 million in ARR also recently got priced at like 500-600. So I think in AI the math is completely off. Most of them will lose money, right? So there is all that dry powder that people thought will go to support some of the prior rounds is now basically getting invested in all these AI hyped companies, and most of them.
But people don't do the math. The valuation on OpenAI is really around how much cloud compute they're going to spend at Microsoft. Yeah. Right? It just doesn't matter. Yeah. That's really 80% of every dollar raised by a Gen AI company is going to be spent on cloud. Guess who benefits? Right? You got to look beyond the numbers, what's being thrown at you in the headlines. Right?
Just one quick comment while I hold the microphone. There's also the other part of looking at what interest rates are doing. So, for example, in our industry, if you look at interest rates, what they're doing to wind and solar installations and how they're killing some of that market right now, literally not figuratively, and so look at how your company is affected by these interest rates, or how you can benefit from that, and not just by looking at the valuation, but the broader macro market that you're looking into.
Okay, that's it. I just want to ask Ben. So Ben, you've got a different perspective. So remind us again where you sit in the market. So you kind of sit with watching things unfold. You're an LP in a bunch of funds. Maybe what stage are these funds investing in? So you've got like beyond information rights into what's happening there, and then where you play in secondaries or primaries or late stage growth, and then give us your view of this topic.
So I think the view I get is I have lots of funds, but it's really through the fact that I get 700 VC decks put on my desk every year for my conference, for Raise. And because of that, I just know tons of fund managers. And I think that we're going through a really difficult time in terms of the small funds. And if you're a founder here, like, this is what really matters, is like how many sub $100 million seed stage VC funds out there are for you to go to, because the rest of the industry is becoming extraordinarily concentrated in these massive, what I call industrial VC. It's 17 funds control like 66% of the capital now. And by the way, you can't even tell who's really investing, in these little funds, because like a lot of them are running out of money. And the number of them is going to go way down. And the number of, in 2021, it's just that it's not an accurate number, but like, there was $13 billion invested in first-time funds. And this is now, a lot of all small funds have second and third, so it's not the whole industry. In 2022, it was $5 billion. Okay? This year is going to be like 1. Like, that's the contraction to first-time funds. And those successful funds, a lot are just like AI or climate Uber operators who are bringing a lot of money to the table. Outside of that, it's hard for small fund managers. And I think the thing that I'm the most stressed about in the industry is like, when industrial VC controls so much of the capital, what does that do to the entrepreneurial ecosystem? I think that it's just something to keep your eye on. I don't have an answer. But now every big fund goes from seed to IPO. Some now even control their investors' money after the IPO. Bonkers, right? What does that do to the ecosystem? It's something I really worry about.
This and rest in peace.
And maybe give us perspective from the secondary. I mean, we threw out some numbers that people email me. Do I want to buy more of a company that I invested in a long time ago? At prices that are like, whoa, let me run the math on that. That's 86% down. I think I'm happy with what I got.
Well, so, I mean, the secondary market, volumes have consistently since 2021, every quarter decreased.
But Ben, can you define secondary?
Okay. For people that know, secondary is when you have a company and rather than selling shares in a primary that goes into the company, you're selling shares to a third party and you're a shareholder and you put the money in your pocket. Okay? This industry didn't exist, before 2011, really. And now it's just a core part of the ecosystem. But it's a very small industry. It's very small compared to the size of the venture industry. There's, less than 20 real firms, and so it's been, everyone thinks like this is the best time ever. But I think that, you brought up Klaviyo, right? Like this is the problem that is experiencing the secondary markets. The discounts that are required to get transactions done, and we do this all the time. We underwrite. We look at the public market where we think a company would trade in 3 years if it's going public. We require 3 times our money, and we have to then roll back to see if this is the price of the shares to buy today. For Klaviyo, which is a really great company. I mean, it's as good as you get. I mean, $600 million in revenue, growing 51% year over year. Very significantly profitable. We would have had to buy at a 75% discount to what the Series D priced at. For us to buy that in the private markets and make a 3x. Nobody is selling an asset that great at 75% discount to the most recent round. And so no deals just, they just don't happen. We just have lots of conversations and it's really hard to get the math to work for the seller. And then if you do find a seller that's willing to sell to you, the company's like, I'm not letting my shares trade at 75% discount. And they just bought the trade.
You get rofer.
No, typically not rofering. Rofering is pretty rare. They just say, go away. And we go away, because we're not going to force it on anyone.
Back to be on the right kind of table.
Yeah. But you're not going to, so you can make deals happen where you're on the inside, where you're already on the cap table. It's much easier to do it then. But the pricing is just brutal. It's brutal, and it's, the volumes are really small. You read a lot about it, but it's not that much happening.
Right. Okay, so when I hear this much doom and gloom, I got to get myself psyched about something. And no matter how bad the politicians are, or the geopolitical, or the economy, or whatever in the venture world, technology seems to still be happening, right? So you can get pretty excited about somebody who's automating human workflows and leveraging data, and wow, that'll save a lot of money, make a lot of money. What are some technologies that are getting you excited about right now that you're trying to have some focus on, or are you super focused? I mean, I remember sometimes the LPs get excited about a buzzword, and the VCs slap that buzzword on them, and then all the startups slap that buzzword on them. Then you've been slapping the AI buzzword since the first wave, and you've powered through it all. What's exciting you guys at BootstrapLabs from a technological, business model, anything perspective? Give us some positives here.
Sure. So we just led an investment in a stealth mode company, but they came out with a new hardware that allows you to capture, the built world in 3D instantly, in a matter of seconds, at a pinpoint accuracy that is required by everybody that does surveys, and that is really exciting. You talk about infrastructure, you talk about all the building that we need to do out there. I think this is where we're going to see, again, user hardware that doesn't exist to capture data that doesn't exist to build a moat. I think that's kind of exciting. So we have a few investments like that where we don't like hardware per se. We think the HaaS model sucks, but it's kind of a necessary evil. But if you have a unique hardware that captures data that no one else has, then you build an interesting moat, right? So that's one. Another one we're looking at on the up. So that was early stage. We're looking at something one-off later stage as a precursor to things we hopefully would do in the growth stage. And I literally watched someone printing a digital worker. And what I mean by that is that I mean a cognitive AI platforms leveraging large language models for their best feature, which is the generative content AI aspect, learning from one another in order to establish in a matter of seconds what the task of this person should be and what are all the variables, and printing that to the back-end infrastructure and call centers, and you're literally printing a digital worker. And that's coming faster than most people can realize, and that's crazy exciting and scary. So with that,
You want more positive or do
What technology is getting you excited?
I am very excited, but also very scared about quantum computing. That doesn't seem like a natural with like the background and what we invest in. But what gets me excited is that the energy and infrastructure industry are waking up to the cyber physical threats on the infrastructure, and that there's more awareness around that topic. So I think that, we're probably going to have a quantum computer, and then we can argue when, next 3 to 7 years, and we have some technologies that we invested in that help critical infrastructure be safe.
Yeah, if you question Andrew already.
Let's wait a little bit. We're going to have 15 minutes blocked out. We're just going to get through this, and then we're going to open it up. So think of smart questions. Jose, I'm sure you've got a good one.
Yeah, I mean, for us, we have 200,000 employees, and we were recently at, with Vinod Khosla, and he basically said you should have 20,000 employees. So that didn't go well with some of the leaders that were in the room. But I think that the broader point still stays, right? All these technologies, agents, co-pilots, whatever we want to call them. So this company that we just funded in sort of the legal AI space, I mean, basically is a general counsel co-pilot. So the AI goes and reviews contract, it extracts clauses, it suggests clauses, it can generate a contract. So just a big productivity driver. We recently had them present to about 100 law firms that are clients of Citi, and it was received very positively. So there's several such examples.
Okay.
Yeah, I think a lot of folks talked about generative AI. I mean, we've been interested in it from the perspective of, there are all these industries that are services industries that were never venture fundable because, how can you make an accounting firm that's 30% margins fundable, or how can you make a financial advisory firm that's 20% margins fundable? We think that changes with what these technologies enable. The other area that we're still really excited about is companies building these platforms at the intersection of a particular industry that then can add on to it financial services or insurance as monetization. And so we have a bunch of those verticalized FinTech companies in our portfolio today. Some of them we're doing, we have a CSR platform that runs all payments from grants, donations, charitable contributions to it. We have a healthcare company that actually provides social determinants of health, and they can run all payments that are being run through that are coming through that ecosystem today on that platform.
So we do late stage, so it's a little bit less visionary. But I love it when you're doing late stage and you see a company that's 20 or 30 million in revenue, and then they just hit escape velocity. And so we're investors in the company Gecko Robotics that is actually very much on your thesis, Ben, which is it's basically a bunch of devices that robots that climb all over industrial infrastructure and look for. It basically creates a unique data set to look for deterioration and vulnerabilities in industrial infrastructure, and you just do the numbers of how many factories and oil tanks are in the world, and you're this is amazing. And the unique data that they create is a great moat, and the business is just blowing up. It's amazing the progress in 1 year. So that's really exciting.
Yeah, I think we'd all agree. Watching one of your companies blow up is a good thing. When they crack into some distribution. Yeah, you need to keep yourself positive. So I want to head into a discussion of how to get our money out of some of these companies. It sounds like the secondary market there's a bid-ask discrepancy kind of gap. So that's kind of slowing down. So you have IPOs, that's for the very few. When the window does open, maybe in normal exchanges, then there's M&As kind of where you expect to return a lot of your funds. Ben, since you sit in the later stage, you can be very optimistic and even, I argue, sometimes unconnected to be irrationally investing at seed stage, inflated rounds. But you got to get a little more sober the closer you get to the only path to exit for a company that big as IPO, or who the hell is going to buy it at this multiple. When the hell are we going to get our money out of these companies?
Well, I'd say I think the real skill that in this next sort of 5 years is going to separate the successful VCs from the not successful VCs is the ability to create your own exits. Whether those exits are through secondaries or for dressing a company up for sale and making it happen. Like, I'm seeing some of our managers just be very, very, very proactive about organizing and pushing for exits. And those guys are going to make money. Sorry, it's breaking up. And so I think that's going to be the key thing. You have to be creative and know how to go create an auction for your company. And that is a really hard thing to do. It takes a tremendous amount of work. It takes organization of the board, alignment of investors, alignment with management companies, but the people that are good at it are going to have Fund 4s and Fund 5s, and the people that aren't are going away.
And, you know, if you had SaaS was kind of steady state at 12x, then it dropped to 5.3, and you're thinking, what's the timing to exit these companies? They might have raised at 40x or some crazy x in 2021. What is your view, guys, on being able to exit via M&A or IPO if secondaries are looking a little grisly with what they're willing to buy in at? So you get that Fund 5.
Okay, maybe I'll start and pass it on to Ben. So in terms of, I think there's some sectors like cyber that are still very, very acquisitive. So we have had some exits in the cyberspace. I mean, Palo Alto itself has acquired probably 15 companies in the last 24 months or so. The data security space has been really hard. A number of acquisitions have happened there, as well as Snowflake and Databricks on the data as the big data platforms. They have been acquisitive as well. Databricks is acquiring Mosaic ML for 1.3 billion, which is almost 20 million per employee. So I think there's not a lot one can do in stuff that one's already invested in. But for new investments, sort of being strategic about where capital allocation is happening based on where there is still a lot of acquisition interest would be a smart strategy.
I'm happy to if you want to.
I mean, I can talk a little bit about like us at Bluebear and why we feel like we have an unfair advantage here. Is a large portion of our LP base comes from the energy private equity industry. About 40% of every dollar spent in the energy market is privately owned businesses. So like just build that connectivity layer that Ben talked about early on and have that almost be embedded in what you're doing and to talk to your, if you're, I think this battery is going up, so there's the energy person here. So just, yeah, also as a founder, be thinking about that and who are your partners on the board and what are their networks and where do you want to take the company and think about that earlier rather than later.
Are most folks later stage entrepreneurs or early stage? Yeah, early stage. Okay, mostly. So we just sold a company, Pismo, to Visa, and I would say that like when you're fundraising, realize that today more than ever, your VCs are thinking about, hey, who could potentially buy this? Do they actually have the capital on the balance sheet to do it? And then do they have the whatever it is, price to equity, enterprise value to sales? Like, do they have the multiple capability to go out and buy, right? That's going to be very top of mind right now.
Just one comment on your numbers, like Andrew, I don't care who you are. If you bought at 40x sales, you're not going to get your money back. It's just that's just what it is.
What about our investment we made together in Prime? By the way, Igor Jadlikov asked me to shout out that we both,
which was far from that multiple, and we got the first check in. But yes, it's I think you need to look at these companies and the time horizon, and I think it's back to what sustainability do they have. I mean, how long can you play the game? The problem is that in the public market, when you buy a high price and it goes down, the only option you have is to really buy back cheaper to average down your cost. You can't really do that in venture. Even in venture GPs, you can't go and buy a piece of secondaries to average your cost down, right? It's the strategy is set by what your LP lets you do, and so you're playing with a pretty constructed box, right? I mean, I'm surprised we haven't seen funds and you can read that people are raising funds to go acquire startups, right? Or to go buy IP or launch IP funds to defend Gen AI startup investing. We're seeing more creativity coming out to the market to solve some of the problems we're seeing. I think people that would come back with not a hedge fund mindset, but So what's like, we find ourselves doing private equity type deals at the seed stage. It's crazy the amount of work and restructuring you need to do right now.
Yeah. I mean, the startups think they're too good for those guys when they are a fit, and then when they're not doing so well and they're ready to go back to them, those guys don't think you're pretty enough. So I think that there's like a bid-ask discrepancy on those things in my little bit of experience. Okay, so let's get into some questions. We've got 4 companies that are going to present, and we want to leave some real time for networking. So questions short, 1 person answers, keep these answers short. I'm not very good at that. And no pitching your startup. Jose, I know you're not going to do that.
I am Jose Bolaños. I'm a retired physician. My question really revolves around what you were saying with regards to the quantum computing, right? And the blockchain uses static encryption keys. And quantum computing is going to kill the entire world in this world. So we need quantum computing, dynamic encryption of the blockchain across